Do I think the U.S. should have a recession now? I don't think so. One comprehensive measure is how much debt has been borrowed. U.S. companies have not borrowed a lot of money. It's been expensive too. And the debt that they have is low cost because they locked it in. U.S. households are under-levered. A measure is called the debt service ratio by the Federal Reserve. It's at roughly 10% of disposable income. Past recession peaks, meaning when leverage gets too high, it gets towards 14 or 16%. So consumers could borrow a lot of money. The only part of the economy that's over-levered is the U.S. government. But the U.S. government has never triggered a recession because they had too much debt. They could trigger a currency collapse, but not a recession.
To all the viewers in the United States, Korea, and around the world, welcome to Global Money Talk by Sunpro TV. I'm your host, Dan Ha. Our guest today is Tom Lee, Managing Partner and Head of Research at Fundstrat Global Advisors. Tom is known for his market calls. He is closely followed by institutions and individuals alike. When Tom speaks, people listen. It is my great pleasure to bring you this conversation with Tom Lee. Tom, thank you.
Great to be here.
So I'd like to start by asking you to please tell us a little bit about how you do what you do. And what I mean by that is the process by which you reach an investment conclusion. For example, to get a long-term S&P target, you project earnings per share out multiple years, throw on whatever you think the right appropriate multiple is, and that's how you can get long-term S&P target. But you also make short-term calls, like this month you think S&P might pull back 10%. So help us take a peek inside your mental framework, the things that you consider, the things that you synthesize, and get to these conclusions, both long-term conclusions and short-term conclusions.
That's a very involved answer because it really involves a lot of the first principles that we use at Fundstrat. But I'd say if I was to give you a more summary form, there's a lot of things we consider. One of the first things that we keep in the back of our minds is that the equity market is the junior piece of the capital structure, which means that stocks respond to economic data and to bonds and to risk, and therefore all of that ends up affecting how the stock market does. So we don't look at the stock market as the tail wagging the dog. It is the tail of the capital structure. And a second principle we always keep in the back of our minds is that consensus tends to be risk-averse and crowded. So meaning what is a widely held view and might even be the most logical is probably also the most logical for most people, and therefore it's not actionable. So we try to think about where the variance or the surprise would occur relative to consensus. And often it makes you come to a counterintuitive conclusion. That process would make you bullish in the midst of a sell-off, and it would make you bearish at the top. The third thing that we always keep in the back of our minds is that there are longer-term drivers of markets, and I think the most underappreciated is demographics, that demographics are more important than even economic policy. And it's something I learned when I was a wireless analyst. Before I became a strategist in 2007, I'd spent the prior 14 years of my career as a technology analyst covering the wireless industry. And one of the things I learned was that the potential of the wireless industry was underestimated by most people because they didn't think about the demographic impact, that if 18-year-olds had a adoption rate of 100%, like you could see it in Korea in the early days, that meant that as they became 40 and 50-year-olds, the penetration rate of older adults would get to 100%. That means wireless would grow vastly over time because of this demographic impact. We found that the stock market really follows very closely the demographic cycles of people aged 30 to 50. And that's kept us bullish since 2009, because that's when that demographic actually bottomed. And the fourth principle we have is that you can't fight the Fed. So in 90% of the instances, when the Fed is dovish, you have to be bullish. And when the Fed is hawkish, you have to be bearish. But 2022 and 2023 was really the exception, because in late 2022, the Fed had to be hawkish optically, but actually they turned dovish. That's the reason we had turned bullish and stayed bullish in 2023, because even though the Fed was explicitly hawkish, they were actually dovish. But I would say those four principles govern almost 80% of how we view markets.
Got it. As a sell-side analyst, a strategist, you have to put a number out. S&P 500, 6,000 by end of the year. But the reality is that the future, as we sit here today, is a range of possible outcomes. So how do you balance that when you advise your clients?
It is very tricky to actually have what we'd call a price target, because you're picking both a level for the markets and then a time frame. And so you're trying to get two things correct. And it's especially difficult knowing that there's really never equilibrium. It's not like the stock market cashes you out at the end of 2024, but we're still trying to figure out where the market level would end up being. Most people who follow and forecast markets tend to do what you just described, which is they give you 3 or 4 scenarios, and they'll say, well, there's a 20% chance this happens, and a 40% chance this happens, and a 20% chance this happens, and so my average target is this.
Right.
I think the flaw in that is that you're now trying to assign precision and probability to 3 different events, and I don't think our clients want that because it's confusing. So we tend to stick with a single number. And the way we develop that single number is everything you've described. We look at what could the PE be, what could the earnings power be, where could the surprise come from, how much will liquidity matter, and how much would risk appetite matter. And sometimes risk appetite is the most important thing, sometimes earnings. And then we actually have to use judgment to decide which one's the most important and come up with a single number. So I would say our targets aren't science, but it's where we're the most confident that that's the most probable path. And it's a process we've been doing since 2009, actually since 2008, and it's actually worked pretty well. I know when I was at JP Morgan, for the first 6 years, we had identified the closing price for the S&P 5 of the 6 years within 1%. Now, it's not that accurate anymore, but in the beginning, the process worked well for us.
Why is it not accurate anymore?
Well, we're directionally correct most of the time. But an example is, at the start of this year, we thought the S&P could get to 5,200. But that was, in December, 15% upside. But not only was the stock market strong in December, we always established the target in early December. Not only did last year, December 2023, the market rise a lot in December, but it was strong in the first half. So 5,200 won't work as a target, as a static target, because that's a 13-month target. But it's directionally correct, because at the time, 5,200 was the most bullish view.
Got it. As you mentioned, you started out as an equity research analyst, covering telecom and tech, then bankruptcies and small cap, then became a strategist. How have you evolved? Your process, your mental models, how you think about forecasting and risk, they must have evolved over time for you. And what were the pivotal moments in that evolution?
Well, I think a lot of life lessons that I live are actually life lessons for markets.
Okay.
I went to a business school undergraduate. I went to Wharton as an undergraduate and graduated, and my first job coming out of college was at Kidder Peabody, which was a stock research firm. And I was very fortunate to have been assigned. When you get a job in research, you don't pick the sector, but I was assigned to the wireless industry, which in the early 90s, it was in its infancy. There were only 34 million cell phones in the early 90s, and today there's 7 billion.
Right.
So you can imagine that that is a hyper-growth industry that has grown faster than even the internet. The few things I learned in wireless was, I think, pivotal to how I view markets. I mean, foremost, the wireless industry didn't generate money. The industry was always borrowing money. And so we had to develop a way to actually value the stocks, the equities, without earnings. And for most of my first, let's say, decade of that career, most people I met would say, Tom, the wireless industry is worth zero because they don't make money. But we'd always be like, well, what is the value of their subscribers or the spectrum they own, because they aren't capitalized on the balance sheet. And eventually they make money, but they have to spend marketing dollars to acquire the customers and build the networks. So it was really during that period that I learned a couple of things. One was that you can follow what the bond market is doing to know if there'll be moves in the stocks. So I learned to call our high yield desk every day and ask them the levels of different companies and were they trading better. And of course, if a bond started to trade well, then that meant that the bond market sensed something was improving, and therefore the stock would react. And so that was very helpful, and it really taught me to look at stocks as the junior piece of the capital structure. Whatever bonds are doing, stocks will follow.
Right.
Another thing I learned was how important the intangible value of an equity is, because in the wireless industry, they had to front load the cost of building the network and then acquiring a customer. So they didn't make money until 1 or 2 years later. And the wireless industry operated as what you'd call a long-term greedy business. They weren't trying to make money in the short term, but all the investment they were making created value in the future. I mean, that's today pretty widely accepted as the lifetime revenue of a customer, or we call it long-term greedy. And that's, a life lesson that you really shouldn't try to maximize how much money you make now. It's more important how much money you make over the cycle. And that's how we look at the equity markets. I think the third thing that really puzzled people was that when I was a wireless analyst, and I became pretty well known as a wireless analyst. In fact, I became institutional investor ranked only 2 years after starting coverage of the stocks, which made me, I know at Smith Barney, I was one of the youngest managing directors. I was 28 when I became a managing director there. And I was very, very fortunate to pick stocks almost at the bottom. And people always asked me, and so I had some very famous bottom calls. One was Western Wireless, which I upgraded at $1.76 the day of the low, and it was acquired by Alltel 18 months later for $40.
Wow.
And I upgraded Alamosa Holdings, which is a Sprint PCS affiliate, at 37 cents, and it got bought by Sprint for $22. So these were hundreds of times returns on investment for stock upgrades.
Right.
And people ask me, how am I picking bottoms in stocks? And what I have shared with my friends but never shared with my clients was that the stocks I would upgrade was based on me talking to all of my clients. And, at the time I might have 70 or 80 clients, so it wasn't hard to talk to everybody. And the ones that they were the most bearish on were the ones that I would upgrade. Okay. And the ones they were the most bullish on were the ones that I didn't think would work. And it's an example of how consensus gets crowded. So I use those same principles today when looking at markets. So, for instance, we found that when people panic about inflation, and I have a chart that we share with our clients, but it's happened 5 times since October 2022. When inflation expectations hit 4.3% 1 year forward, it has always marked a tactical low for the stock market because people get overly worried about inflation. So there's a lot of signal that still comes out of realizing what becomes crowded.
Got it. What was your worst call, and what did you learn from that?
Well, I've had many tough calls. I'd say the two that I always think about in the back of my mind, one was from 2004, and it was a long-running story arc, but in 2004, I turned negative on a wireless company called Nextel. And at the time, we were doing a lot of analysis of balance sheet quality and the quality of customers. And what we found was that we thought that this company's subscriber base wasn't as high quality as they claimed because of changing policies around churn and the way they capitalize certain items. And so we put a sell rating on the stock. And it became a very public battle with the management of that company because they viewed us as hostile to them, naturally, because we had a sell rating. And they were also a big investment banking client of the firm I was working at. So I was getting a lot of pressure to say favorable things about them. And a lot of my clients actually turned on us because they were angry that we weren't recommending a stock that they owned. But so we stuck with our negative rating. Eventually, the company was acquired by another company, and it turns out many of the things that we thought were quality issues basically came to light, and the acquirer almost imploded because of that. So in the years afterwards, so many of my hedge fund clients said, Tom, you nailed that call. I can't believe that you saw these things before anyone else did. Yet, to me, it was a huge loss because we had so much damage to our relationships. You know, people were they hated us for years that we didn't recommend a stock that they owned, that I was like, like having a sell rating, it's tough because you end up making enemies, and if you're right, they're not going to say thanks because they lost money on the stock. So I learned that it's very tough for investors to accept this idea that someone's trying to make you money. Like, our business is to try to make our clients money. We're not trying to be right. So that, to me, was very eye-opening. And I'd say that the second thing that sticks in my mind is being wrong. And, we've been wrong a lot. We're going to be wrong a lot just because you can't get every call right.
Sure.
But I would say that it was really early 2022 that I regret not paying more attention to Mark Newton, who is our technician. So at my company, we have different silos of expertise. So I do macro research, which is fundamental analysis. We have Mark Newton, who does technical research, and he does cycle work, and it's very involved. He looks at so many different chart type models, whether it's DeMarks or stochastics or Fibonacci's or even other longer term cycles, liquidity cycles. We have a policy strategist and we have a crypto strategist named Sean Farrell. Well, in 2022, Mark had warned me. He's like, Tom, the market has gotten really weak. So at the start of 2020, he said, it is a really thin market and it's very tenuous. And so he thought we would be down more than 10% in the first half. And we were cautious in the first half of 2022, but we thought if you were down 10, you'd buy that. But he was adamant. And of course, we fell more than 10%, and Mark was still bearish. And he turned less bearish around August of 2022, which was the market's internal bottom. So that really taught me, and this only happened a couple years ago, that, liquidity and technicals, they can be so variant from what is common perception that you have to pay attention. So, subsequent to that, Mark and I work really closely, and I always like, Mark, you got to warn me. Next time you think there's a big drawdown coming, we should spend a lot of time figuring that out. And so, of course, that's what we do.
Got it. Your transition from a fundamental equity analyst to a strategist obviously couldn't have happened overnight. I mean, you may have gotten a new job, therefore you can say it happened overnight, but the way you think about investing, markets, and forecasting could not have happened overnight. So can you share a bit about that transition?
I think it's actually been one of the strengths that we've had doing macro research, is that we come from a stock picking, bottoms-up research world.
Right.
Most equity strategists are macro people that are economists. And then they may follow economic data, but then they build what I would say is a stylized model of the economy and the stock market using indicators. They might say, I'm using PMIs or, liquidity or earnings. But we approach the world at Fundstrat more as the stock market is the composite results of the 500 names in the S&P. So I always think of it as these are individual companies that comprise the index. And the reason that evolution came for us was that when I was doing wireless, I had to do quite a lot of thematic work because it was a new industry. Many of my clients never heard of wireless, and there was also a very big age difference. Most people who manage money are in their 40s or 50s. Wireless was a new technology, and I was in my 20s at the time.
Right.
And I quickly learned young people adopt technology which most investors don't understand and they're skeptical of. And I witnessed it. We've witnessed it many times since, whether it's social media and how people have dismissed Google and Facebook, or how people have missed crypto, or even how people missed AI. A lot of people were dismissing AI just 2 years ago, saying it's not going to work. People are too optimistic, and look at AI now. So I've learned to look at the world through younger people's eyes. And so much of the work I did as a technology analyst was thematic, large think pieces I would publish. And I was at JP Morgan at the time, and they found it as the work I did was helpful to teach other analysts. So they had asked me to become the mid-cap strategist in around 2006 or so. Around that time, JP Morgan opened up a new research office in India, which was underutilized, had 40 analysts. And so one of the projects I thought of doing was to look at bankruptcies, because wireless companies were going bankrupt. And so I sort of put this task list together to go through over, I think, 4,000 or 5,000 bankruptcies since 1970 to follow what happened to these companies. And it turns out that many of these companies that come out of bankruptcy come out much stronger. And so we wrote a book called, or a white paper called Chapter After Chapter 11, which became very popular, but it was basically recommending certain stocks as they came out of bankruptcy. So I was a mid-cap strategist for a while, doing bankruptcy research and wireless. And then in 2007, they asked me if I wanted to take on the larger role as the head of macro strategy. And that's when I started to do it. And sorry, it's for a long-winded answer, but at the time I was doubtful I should do it because I still viewed myself as someone who looks at 10 Qs and picks stocks.
Right.
And I didn't think anybody could actually forecast the stock market itself. But what I said was I would study it, and I did, and I came up with our own approach, which included those first principles I mentioned. And we started to write about the stock market in that way, which was very different than most strategists. Because most strategists will be like, oh, the ISM's at 45, which implies S&P earnings growth of X, and then you just throw a PE on it, and that's where the target is. And I could never believe that would actually work. So we come up with a very different approach. Is we view this as stocks, what stocks could lead, and then how does that drive the value of the index.
Got it. So speaking of that, your S&P 500 target, whether it's the near term, 6,000 by year end or 15,000 by 2030, it comprises multiple assumptions. What are the key assumptions, and which of those assumptions do you have the least confidence in?
I might answer that by explaining that a mistake most people make is putting too much credence and weight on PE. Okay, so in other words, when people talk about the stock market, you'll hear a lot of experts say, oh, well, the PE should only be 18 times or 15 times this earnings, and therefore the stock is a sell.
Right.
I never understood it because, number one, in Wharton, when I took all my classes on finance, no one ever actually said PE was something tangible. PE is a residual calculation.
Right.
You have the price of a stock, and then you have a fundamental metric. Now, it could be earnings per share, it could be cash flow per share. What we never know is the reality is which earnings period are we looking at? Are we looking at last year's earnings or earnings 2 years from now or 20 years from now or next quarter? Are we more caring about cash flow or earnings or EBITDA? And then what's the right risk appetite? Because a PE in a world of 10% inflation is different than a PE in a 2% world. A PE is different if there's high cost of money or high risk aversion. So I always view PE as a residual calculation and actually not that important. And so when we think about where markets can go, we tend to think of it as how much we do stick with an earnings concept. We need to know what earnings power is.
Right.
But we're not anchored by it because earnings delivery can change because of concurrency, labor cost, margins, government policy, buybacks. So we think of earnings as sort of a base case. And then we sensitize it and ask, could earnings do better than expected or worse? And then we think about what that would mean to the PE. So we're not as anchored to the idea that, oh, hey, the forward earnings of the S&P is at 19 times, which it is today, the index, so it's a sell. Or someone will say small caps, PE is 24 times, so it's a sell. The reason I don't like that concept is that, one, there isn't really S&P earnings per share. It's the earnings of all these companies. And in the S&P today, for instance, the Mag 7 trade at 29 times earnings. So it makes the market look expensive. The median PE in the S&P is 17 times forward earnings.
Right.
And that's not at equilibrium. It's a moving target because earnings could do better or worse. The median PE in the Russell 2000 is 11 times. Now, over 30% of the Russell 2000 doesn't make money, but the vast majority of those that don't make money are biotech companies, and then there's a lot of regional banks, but regional banks are doing poorly because of monetary policy. So I'm not as constrained about what the Russell PE should be because I think the earnings could move a lot more in the next couple of years.
Got it. The economy hasn't had a broad-based recession since 2020, and arguably since 2009, depending on how one considers the 2020 COVID recession. But there's been pockets of recessions, whether it be durable goods, housing, unprofitable tech, or early stage venture, M&A, IPOs, and even crypto. Minus the major ones. A lot of the ones that probably should have never existed have all crashed. Is that it? Meaning that's the recession that we were supposed to get this time around, a collection of isolated recessions?
In a way, what you're describing are rolling recessions, right? Because pockets of the economy are contracting, but it's not large enough to cause the entire economy to be in a contraction cycle.
Right.
I think business cycles are very mysterious. I mean, if you use the NBER's dating system for recessions, and from 40 to 1990, economies were really frequent. In fact, the U.S. probably spent close to 40% of the time, 30 to 40% in recession. So in other words, in 10 years, you have 4 of those years are a recession. I mean, which is a lot of the time.
Mm-hmm.
But it made sense. Back then, manufacturing, which is super cyclical, was a large part of the economy. And as you know, there's the bullwhip effect around manufacturing, which leads to over-ordering and busts. So the economy, U.S. economy, was a boom-bust because manufacturing was such a big part of the business cycle. Since the 80s and 90s, the U.S. economy has evolved, and globally it's evolved. First, it's because the service economy has grown. Now, service is an encompassing word. It means healthcare, financial services, tech, transportation.
Mm-hmm.
But the service economy itself is less cyclical. It's steadier.
Right.
And government spending has become a larger share. So manufacturing, which has gone from being the largest share of the economy, is now arguably the smallest share.
Right.
And therefore, we should have fewer business cycles, which has actually been the case. Now, that business cycle volatility has been pushed to other countries, which do more manufacturing. That's why Asia is more of a boom-bust economy. And believe it or not, Europe is primarily a manufacturing economy. Germany itself is one large manufacturer. And so Germany and Japan and Asia spend twice as much time in recession as the U.S. So the U.S. is essentially a consumer economy with a huge amount of accumulated wealth. The household net worth in the U.S. today is about $150 trillion.
Mm-hmm.
Let me just put that in perspective. The U.S. GDP is $25 trillion. So U.S. households have saved or have a net worth that is roughly 6 to 7 times the U.S. economy.
Right.
We could shut down the entire U.S. economy and we'd still have GDP because the U.S. consumer has $150 trillion of wealth. That is by a country mile. We are the wealthiest. The U.S. is the wealthiest nation. And I think that's why the business cycle is less tied to economic activity and maybe even more sensitive to the stock market. So the trade-off is, of course, the stock market has a psychological impact on the economy. So if we have a stock market crash, we're almost guaranteed to have a recession. Other countries could have a stock market crash, and it wouldn't affect their economy because very few people own equities. So that's, I think for someone who's looking at the U.S., that's something to keep in mind. And do I think the U.S. should have a recession now? I don't think so. One comprehensive measure is how much debt has been borrowed. U.S. companies have not borrowed a lot of money. It's been expensive too, and the debt that they have is low cost because they locked it in. U.S. households are underlevered. A measure is called the debt service ratio by the Federal Reserve. It's at roughly 10% of disposable income. Past recession peaks, meaning when leverage gets too high, it gets towards 14 or 16%. So consumers could borrow a lot of money. The only part of the economy that's over-levered is the U.S. government. But the U.S. government has never triggered a recession because they had too much debt. They could trigger a currency collapse, but not a recession.
So speaking of household wealth and borrowing, asset prices of various kinds, whether it be stock market, gold, Bitcoin, home prices, are at or near records, which means that wealth is at or near records currently. And the Fed is about to make borrowing cheaper, or it's already started to do that. Why wouldn't this reignite inflation?
I think that there is not a direct relationship between asset prices and inflation. Many people think there is, and there logically should be, but we know many instances in many countries where you've had asset prices rise and it has not triggered inflation. In fact, you might even have some countries that are suffering from deflation. Inflation, which is a mysterious phenomenon, is best traced to, I think, in the Fed is acknowledges, to a change in how consumers and businesses expect price changes to take place. So if a consumer owns a lot of stocks and it's gone up, it doesn't mean that they expect the price of a car to go up or the price of a house. House and the car, by the way, is 60% of the CPI basket. So if those aren't going up, then is it hotels, restaurants, clothing? These aren't necessarily tied to stock prices. They are tied to wealth and spending ability, but the flip of that is the stock market isn't held by everybody. Most of the wealth of the stock market is held by a small percentage of households. So asset prices making new highs is not the sign of a top. In fact, in a bull market, you'll be making new highs all the time. You know what I mean? Like,
Right.
if you're in a bull market for stocks, it's always going to make a new high. So you can't say it's topping. I would say, to me, when the last stock that should never have a high multiple gets a high multiple is really when you get a top. And, when I see financials trading at 10 times earnings, a lot of staples have derated. I mean, small caps at 10 times earnings, I'm not sure it's a top.
Speaking of high multiples, Goldman recently made a prediction that the S&P 500 would return 3% a year for the next 10 years, citing, among other things, near record CAPE, cyclically adjusted PE, and concentration in the index. The call itself, the prediction itself is an opinion, but the CAPE and the concentration being near records, these are observable facts. You're long-term bullish. How do you take the same facts and get to a long-term bullish conclusion?
Well, I haven't seen the Goldman report, and so I can't speak to how they got to their conclusion. I won't doubt that they have done some work and they can show some charts. But I would just point out that cyclically adjusted PE, if we look at the chart, you would have actually sold the S&P already in 2014. So you would have been out of the market for the last 10 years because you revisited all-time highs on CAPE. So my guess is that someone who did this analysis in 2014 at an all-time high CAPE would say the next decade would have subpar returns, and the S&P has been 13% a year.
Right.
Second, I think that's another example of what I would call someone doing high-level analysis to explain stocks. Does this analysis capture the impact for AI? Does it capture the changes that could come with onshoring, with the changes in government policy around cost of energy? Does it capture demographics? None of those are reflected in a CAPE, and none are reflected in concentration. So I'd almost say that someone who would lend credence to that view is giving up all the discipline about equity investing in the first place. I mean, just as an observable fact.
Right.
That would be like someone saying, Tom, forget everything you know about investing and just look at one metric. But here's another intuitive way to look at it. If someone says the market's going to grow 3% a year, well, what will earnings do? Are earnings going to grow? Well, let's say GDP is 3 real, so that's nominal of 6, plus buybacks, so you have 9% earnings growth. So are they saying PE would contract 6% a year? So the PE is at 17 times now? Well, in 10 years, the PE would be down by 70%. So they're saying the PE goes from 17 to 10. Okay, so if PE goes to 10 and earnings grow at 9, we'll have 3% total return. But is that a reasonable base case? I mean, I don't know.
What about the concentration piece? That in order for the S&P 500, the cap-weighted S&P 500, to deliver strong returns over the long term, the top companies need to deliver high rates of return, the stocks.
It's actually not true. If you look at every 10-year period, 40% of the S&P return comes from companies that were not part of the index at the start of that period.
Right. So
10 years from now, only 60% of the index will be the same. 40% are completely new companies. Are these 40% going to deliver worse earnings growth? I mean, I'd be skeptical. Secondly, when people talk about concentration, the largest stock in many countries is often 27% of the index, whether you're looking at the UK, France, Germany. You look at most Asian countries, typically the largest stock is over 20% of the index. The largest stock in the US is 7 or 8%. I mean, we don't really have the concentration other countries have.
Right. What is an idea of yours that is most overlooked? In other words, that one pitch that you just can't get enough people to pay attention to.
Well, there's two kinds of skepticism. The one that we get the pushback on consistently is Bitcoin, because we've recommended at least a 2% allocation to crypto for 8 years now. That original recommendation would now be 40% of their portfolio without rebalance. If they owned a little bit of Ethereum, it'd be 80%. But today we still get people telling us, well, Bitcoin doesn't do anything. But it's gone from 1,000 to 72,000. The second thing that we get pushback is the idea that people in general think of us, if something isn't working now, it'll never work. And that is small caps. I think small caps could really be the star of the next decade. And it's because they've derated so much, but these aren't bad businesses, and they're under-owned today. And in fact, people are so liquidity-centric that they tend to avoid them. So I think there's a big opportunity in small caps.
Well, we'll have to leave it there. Tom, thank you very much.
Great, thank you.